In part 3 of this educational series, we will be putting 2 and 2 together and coming up with the weighted average cost of capital for a company. So let's jump in. In parts 1 and 2, we got a pretty good understanding of how to calculate the cost of equity as well as the cost of debt. If you still need to go through those, then just click on the suggestions link on the top right corner. If you're comfortable, then let's move forward. Let's dive into the calculations. Let's start with cost of equity. We learned 2 ways to calculate cost of equity, right? One was based on the perpetuity, if we assume that dividends would remain constant forever. The other one was that if we assume dividend grew for a constant rate at 6% per annum, then we use the dividend discount model. For this example, let's go with the perpetuity method. So what do we have here? We have a current dividend at 32 cents and a cum dividend market price of 250 cents. Okay, no growth rate has been assumed, means we're expecting the dividends to remain constant in perpetuity. The market price is based on cum dividend. That means what exactly? Yeah, we have to exclude the amount of dividend that is going to be paid. And we are going to use the ex-div market price. So let's begin. So we came up with a cost of equity of 0.1467, or say 14.67%. Moving on to the cost of debt, we have interest of USD 8 each year, assuming a par value of 100, all right? The tax rate is 30%. The market value is at 92 for each 100 nominal. All right, so there is no redemption. So we can easily assume that this is the case of an irredeemable debt. What do we do when it comes to irredeemable debt? You take your interest, you net it, you net the tax amount, the tax impact, you divide it by the market value at that point in time. If we had a redemption amount, then you remember we calculated, if you have a redemption amount after 5 years of 100, then we have to do the IRR method. Then we have to calculate the cost of debt based on the IRR. You remember IRR, right? Where we had to make 2 intelligent guesses, one positive, one negative, then you interpolate and you come up with one rate. That is the rate that equates your NPV equals to 0, that makes your NPV equals to 0. It equates the present value of future cash inflows to the project's cash outflows. In this example, we have an irredeemable debt, so we don't have to do the interpolation. Let's give it a shot. So we come up with a cost of debt net of tax of 0.0608%, or say 6.10%. Notice one thing. Let's discuss this. It's important. Your cost of equity is 14.7. Your cost of debt is 6.1. Your cost of equity will almost always be greater than the cost of debt. Why? Because there's a greater amount of risk involvement in the cost of equity. Why? Because interest income on debt is constant. You know you're going to be getting 8% each year. But do you know that if XYZ company paid 5 rupees last year, are they still going to pay 5 rupees this year? No, we do not. However, when it comes to interest payments on your debt, that is almost always guaranteed. That is one element. The second element is that interest payments are tax allowable deductions. We discussed this in part 2. It reduces your tax burden. So that is one other reason why KE is almost always going to be greater than KD, because interest payments on debt are tax allowable while dividends are not. All right, let's put together the puzzle. WACC is derived by the firm's KE and KD, cost of equity and cost of debt, and weighing them according to the market values of each source of finance. Let's break this down. In the previous slide, we got a KE of 14.7 and a KD of 6.1, right? Moving forward, here are your sources of finance: equity one, debt the other. We took the costs, which we calculated in the previous slide: 14.7 for equity, 6.1 for debt. So we got the cost of equity and cost of debt. Now we have to weigh these according to the market values of each source of finance. Always remember, in the exam, the examiner gives you the market values. You make sure you use the market values so you get an up-to-date weighted average cost of capital. Otherwise, you're going to get, you can get a weighted average cost of capital, but it would be the existing weighted average cost of capital. Means existing means you're going to be using values in your balance sheet, right? Which are based on the previous amounts of finances you raised from equity and debt. But we're going to use the weighted average cost of capital to discount a future project, a potential project which the company may take in the future. So what positions should we use, in your opinion, to get more accurate figures on which the upper management could come up with a decision? Exactly, you should use the latest market values. All right. So you guys are finance managers. You are assessing a project and you come across this data, and you're thinking, no, we do have the cost of equity, we do have the cost of debt, but where do we get the latest available market info from? So you open the financials, you took out the shares that are in issue, you went to the website, you went to the stock market website, you took out the share price, and you came up with a market value of 10.9. All right, you got the 5 million shares over here from the company's financials, you got the 2.18 share price, current share price from the stock market, the stock website. You come up with a market value of the equity of 10.9. Similarly, you go to the website that is used for trading debt. In Pakistan, the website that gives you the market value of debt is Mufab. All right, so you go there, you get the share price of the debt which you're thinking to raise finance from. It was 92. So you did that. You know the par value is 4 million. You divided 92 by 100 times the par value and you get a market value of debt of 3.7. So your total capital would be 14.6, 10.9 plus 3.7, 14.6. Based on this, you calculated a weighted average cost of capital of 12.5, and this is going to be used in your as a discount factor when you appraise the investment. Let's break this down. Wait, don't worry, I'll walk you through it. How is weighted average cost of capital derived? It is derived by the firm's KE and KD and weighing them according to the market values of each source of finance. Yeah, let's rewrite this equation. I want to make sure there is no confusion by the end of this series. All right, so let's read the definition again and form an equation. It's formed by the firm's cost of equity and cost of debt and weighing them according to the market values of each source of finance. Try to make this equation yourself. You can pause the video if you like. So we come up with a WACC of 0.1247 I hope you guys were able to make the equation. If not, you can always have a look at this and get a better understanding. So we came up with a WACC of 0.1247, or say 12.5%. So this is your cost of equity. Now you have to weigh it according to the market value of each source of finance, right? So we wrote 10.9 in the numerator, which is the market value of equity, divided that by the total capital, which is market value of equity plus the market value of debt. You do the same for cost of debt, and you add up the products of both, and you come up with a WACC of 12.5%. Always remember, if there are more than two sources of finance, you would have to calculate the cost and add the weighted average in the similar way. Now, in this example, we used an irredeemable debt. Just assume that you had a case of redeemable debt. So you'd have to make that table again. You'd have to make the IRR tables again, come up with a rate that would make your NPV equals to 0. And you would add another equation here. And then that would be, you would add the product of that equation to the earlier equations, and you would get the revised weighted average cost of capital. It's really not that complicated. Just coming up with the IRR is time consuming, but it's very simple, very easy. All you need to do is practice, practice, and practice. So what have we learned? We learned that WACC is the weighted average cost of finances for the company. We learned how to calculate the cost of equity for a dividend that stays constant in perpetuity, and using the DDM. We learned what cost of debt is. We learned how to calculate it. We learned that the tax on debt is a tax allowable deduction. We learned how to calculate the cost of debt for irredeemable debt as well as redeemable debt. We understood the concept of IRR, and we also learned how to calculate IRR based on interpolation. And finally, we put 2 and 2 together and we came up with the weighted average cost of capital. In the next lecture, we'll be discussing the portfolio theory, which is a prerequisite to understanding the capital asset pricing model. It's a very interesting and important model, and a lot of brokerage houses and analysts, they use it to value the stocks and bonds. How do you come up with their market values? They are simply the present value of future cash flows. For stocks, it is the present value of future dividends, and for bonds, it is the present value of interest and principal payments. You get the present value of those. It's relatively easy to calculate the present value of stocks, but for bonds, you have to draw up an entire table showing the interest payments, showing the redemption, using the discount factors, etc., etc. And it's much easier to calculate the price of a bond in the real world, because we just use the price function in Excel, but for the exams, you will have to draw up the table. I really hope the information turns out useful for everyone. I'll be working on prepping presentations on the portfolio theory as well as the capital asset pricing model in the coming days. Be sure to subscribe and hit the like button. If you have any questions, be sure to leave them in the comments or drop me an email at dollarsandcents90@gmail.com. If you have any specific requests of any particular topic, make sure you let me know. Thank you for your time.